good evening. I'm Melisa Idris. Welcome to Consider This. This is the show where we want you to consider and then reconsider what you know of the news of the day. Now, as I'm sure most of us are aware, Malaysia is facing an impending retirement crisis. And to address this growing challenge, the EPF recently introduced the Retirement Income Adequacy Framework. Previously, there was a single-tier savings benchmark, which sets the recommended minimum retirement savings at 240,000 ringgit a month, 240,000 ringgit by the age of 55. That's 1,000 ringgit a month if you live up to 20 years after retiring. But the new RIA framework is a three-tiered savings benchmark: basic, adequate, and enhanced. And it's meant to be used as a reference to maintain different levels of financial security post-retirement. So the question remains with the RIA framework is whether this is enough to secure financial security in old age, and can it adapt to rising cost of living and economic uncertainties. So today on the show to discuss this further, I have Professor Joseph Cherian, who is the Deputy CEO and Practice Professor of Finance at the Asia School of Business. Welcome to the show, Joe. It's good of you to join me.
Thank you.
So before we get into the RIA framework, I was hoping maybe we could start broad. If you could help paint a picture of the current state of retirement security in Malaysia and why this is a pressing issue for our country.
Okay, so first of all, a word from the sponsor. We do have a very good retirement system, both the EPF, which is a defined contribution system, and the Co-op, which is a defined benefit system. So both were set up in a very robust way and managed in a very robust way, but somehow we lost our way along the way, okay? And that's why we have a bit of an inadequacy problem. So that's the background. Now, where are the gaps? I guess you're also asking where are the gaps?
Yes.
Well, there are some gaps. You know, one is everyone wants to know, how can I take a sum I've worked hard to save for my future, that's for my retirement period, how does that translate into a decent income payout for as long as I live? Right? That's the first thing. So basically in pension parlance, we call that life annuity. You don't want to wake up after 20 years beyond retirement and, pardon the expression, find that you've not kicked the bucket. What happens beyond that, right? So you want some kind of security for life. And you rightly pointed out, what are the guarantees or warranties? That's where you need some government intervention to provide the risk as the management if you live longer than what's expected. You know, there's a mortality age, they say 20 years beyond retirement, all that, but there's a margin of error around that, right? Some people live to 95, some live below that. So we need to be able to hedge that risk. And usually the best party to hedge that risk is the government. So Malaysia and Singapore, for that matter, have very good, robust, nationally mandated social security system. It's the best way to guarantee that. But unfortunately, we are stopping in 20 years, and that's part of the problem. Okay? The second thing is inflation indexing. You don't want to wake up one day and find out you don't have enough to live on because the healthcare costs have gone up, the cost of food has gone up, and you only have this fixed income payout. Even if it's for 20 years, it's fixed. So you need to make sure it keeps up with the cost of living, that payout, beyond retirement. The third thing is the gap. How do you take care of the people who don't have the means? You must always look out for the B40, the indigent, the people who have just fallen between the cracks, no fault of their own. There must be some mechanism to take care of them. That's what we call a needs-based pension system. So these are the three things that I think are very basic that we need to figure out.
Okay, so part of these three things, let's talk about the RIA. What are your main concerns when it comes to this framework?
First of all, it's a very commendable program. They've actually thought about a lot of things, and they have actually designed something that makes a lot of sense. It makes eminent sense. The problem is, I told you about the 20-year period.
Yes.
What happens after 20 years? So we need to make sure it's guaranteed for life. That's where the government, through the insurance protection or guarantee system, provides the excess tail risk hedging. That means if I live longer than that period, I still have some access to income. you know, that's not easy for the private sector to provide. So you can say, oh, why don't you buy tail risk insurance and get an annuity?
I was just about to ask.
The problem is, let's say you wake up at 85 and we are not gone yet, okay? God forbid, we're still alive. I'm sorry, I don't mean it that way. But, you know, that you have lived longer than expected.
Well, you've outlived your savings.
Exactly, you've outlived your savings, well said. And you also find out the company that guaranteed that insurance protection through the annuity is also gone bust. That's a problem, right? So, and that's happened in the past. It's happened in America, that insurance companies have gone bust. So the annuity that you bought doesn't exist when you need it the most. That's where the government has to step in, at least at the basic level. I think the EPF calls it the dignified or basic level of expense. And I must tell you, the Belajawan coup, I went to the website. It's actually fantastic. Not many countries have that. It tells you by region and so on what your expense rate is going to be, whether it's East Malaysia, West Malaysia. That's all very creative and very commendable. So we've got to pick out the good points that they've done. So I can actually estimate, if I live in Terengganu, how much would I need per month to maintain a dignified standard of living. Right. Then I can plan backwards, how much do I need to save to get there. That's what the EPF tries to do. So coming back to the point of living longer, you need some kind of warranties or guarantees, and usually it's best that the government provides that. Through the savings, that means some part of the savings is used as a government insurance premium to protect you when you live longer than 85.
That's not the current structure.
That's not the current structure because it's only thought out for 20 years. But there is a structure that's available now in Singapore. They have a CPF Life. So the CPF Life, the beauty of it is it lasts as long as you live, the payment. Now the beauty of the RIA system, the way they designed it, versus a CPF Life, is CPF Life, it's flat. It doesn't adjust the cost of living. If you look at the RIA payout, it actually adjusts. So that's good. They got that part right. Okay. It adjusts to the cost of living. So as it grows out, because inflation is usually positive, you get more until the age of 85.
Joe, what are the obstacles to implementing a life energy system for Malaysia?
Actually, it can be done.
It can be done.
It can be done because the big problem you have is pooling the risks. And that's why I say we are very blessed in Malaysia because we have a nationally mandated pension system.
Okay. The structures are there, yeah.
It's already there. So there's this risk pooling of lifespans, health conditions, everything. So you have no excuse not to provide that guarantee. If you ask a private insurance company to do it, maybe just 10% of the cohort will invest in the premium, in the annuity. You don't have the risk pooling mechanism. Right. So we actually have all the ingredients to provide it, but we need the sort of government's will to actually provide that. Okay. And I think it can be done because our neighbors have done it.
Is it a sensitive or controversial initiative?
It should not be controversial. Okay. It should not be sensitive because this is the way in which everyone wants. See, if you remember in the old days, we all got pensions, right? Right. And private sector, government sector in America, Australia, Singapore, Malaysia, everyone's getting pensions. But they're unsustainable. But that's what people want. They want a certain amount of
security
till they die, which is what the pensions is. So what we're saying is transforming that unsustainable pension model, and I'd be happy to talk about the pension system as well, which is the co-op system. Right. Again, a good system, but it has to be sustainable. Many countries, America, Australia, Singapore, many countries have found that it's not sustainable. So they moved to the defined contribution model, which is like the EPF. 401k in Australia, in America, CPF in Singapore and so on. So they're all defined contribution systems. But the national pooling is what makes it easy for them to provide this guarantee.
So you mentioned earlier that the RIA is adjusted for the cost of living as...
It appears that way.
It appears that way. But you are suggesting it ought to be inflation indexed.
Well, it can be. I think they used inflation indexing. I'm not sure how they came out because I don't have the details of the formulas. It should be inflation indexed so that people can at least keep up the cost of living. So if the price of bread, milk, eggs go up, this payout will go up naturally.
They said they would do this every 3 years. They would revise.
They would revise because inflation rates change.
Is that sufficient in terms of timing every 3 years?
It's hard to say what is sufficient, but I can tell you what's the best way to do it, the way the Americans do it, which is inflation index bonds. It adjusts every year to the rate of inflation you experienced.
Oh.
So, and I practice what I preach. I actually invested in inflation index bonds in America because I lived there for many years. I'm Malaysian, but I lived there for many years, and as a permanent resident, I'm allowed to invest in these things. So remember, inflation during COVID went up to 10, 12% in America. So the inflation index bonds that were indexed to the rate of inflation over that year were paying 10, 12% plus whatever the coupon was on the inflation index bond. In my case, I bought it at 3.4%. So I was earning 3.4 plus 10 plus percent. But do you see what I mean? That's nothing to brag about. It's just doing what it's supposed to do. So I will not be crying, oh my gosh, inflation, inflation, because my coupon adjusts automatically. So I have enough to pay for all the cost of living adjustments. That's the way it should be designed. But 3 years is a good start.
Okay, all right. So maybe in the future they might revise that to make it more frequent, frequent adjustment. When you talked about the gaps, the needs-based social security for the people who don't have EPF, they're not EPF, formal EPF members, lots of gig workers, lots of people working in the kind of shadow economy. How do we think about helping those, so make sure that no one suffers old age poverty for the people who haven't met the savings threshold? Yeah,
so if they're young and they have a long runway to retirement, including gig workers and everyone who's working the shadow economy or whatever, we should make sure we get them started on this program. There's no free lunch. So they must put aside some amount, and perhaps, again, I'm not a socialist, but I feel the government can support by saying, hey, for every dollar you put in, I'll put 50 cents. Give an incentive for these people who are usually in the lower rung of society, but they're starting late because a lot of them are young. Tell them, you put $1, I'll put 50 cents in. Again, many countries have this principle where they do matchings.
Oh, really? For instance?
Singapore.
Singapore has a matching system.
They have matching in some cases, not all. You know, it depends how low you are, and in some years, because they have a budget surplus, they say, we'll match a certain amount if you invest this much. So it's common to do that. The most famous is employer matching. We have that. When you put, I forget how much it is in Malaysia, 12%?
11 to 12%.
11%, 12%. The employer puts in 8% or 9%. Same in Singapore. There's a matching. 401k in America, which I'm a member of. I have CPF and I have 401k. And basically, in both cases, the employer matches. So, you know, and there's a tax deduction to that. They're not just doing it out of goodwill. They also get a tax benefit from all the matching and so on. So,
help me think through, Jo, the balance, right? Because often retirement security or retirement savings is seen to be an individual responsibility, not really a societal one, not really a governmental one. How do you balance that, the need for social safety nets and adequate retirement savings as the owners of the individual?
So first of all, let's not forget we need to take personal responsibility. So those who can afford it should save for the future. But we also don't, you know, when you have societies where there are too many poor people or people who feel left out, you're going to have riots. The rich people, the ones who have saved enough, don't want to see riots. They want to see a happy population and everyone progressing together. We must have some kind of charitable motive here or philanthropic motive. There are people who need help. We should help them. So there must be a system. I keep saying it's a needs-based. It's not a universal basic income. I'm not a fan of the universal, everyone getting a payout.
What do you think about the universal basic pension? Essentially, it's a pension to avoid old age poverty.
Yeah, well, if you think of universal basic income, they're saying, oh, let's use the surplus revenues from some oil fund or whatever and make sure everyone gets the same payout. You know, I'm not a big fan. That's a very costly proposition. And furthermore, I really don't see a need to provide this income to those who have enough. Now, of course, you can say, oh, we can allow those who have enough to donate that to those who don't have enough. There are some countries who have done that. You can actually donate your gift. It's just too complicated. Just make it needs-based. That's my view. Make it needs-based. It's affordable. Make sure no one's left behind. It's good for those who have enough in savings because it ensures a very progressive, happy society. I think that's what we all want. So I think it's good for the country to have some philanthropic motive and take care of those who are just not going to make it. Coming back to your gig economy, I think they should participate. Actually, Singapore again, Grab employees and so on, they have to actually start contributing now. And the employer has to match, that's Grab. If I'm not mistaken, there's a formula that there's matching. And again, the government comes in a little bit. Just to support and help things through, they provide maybe a bit of the matching or something like that. So we have to be creative. It can be done, but we can't just leave things the way it is and say, oh my gosh, we don't have enough for saving, for the future and so on.
Well, if we take a look at the EPF figures for just using that basic savings benchmark, the 240,000 ringgit by age 55, at this point in time, they said only 36% of their former members will meet that at age 55.
Yeah, I think at a certain age group, maybe at the age of 55 and above.
And above, that's right.
Have only that. So this is a very serious problem, right? And part of the reason why we got into this hole is because we allowed people to withdraw early.
During the pandemic?
Of course, we did that. Many countries, we are not unique. Malaysia, America, Australia, India, and Malaysia allowed dipping into your savings. In fact, Australia allowed up to 20,000 Australian dollars. America allowed up to 100,000 US, if I'm not mistaken. I know we had 2 or 3 programs where it came out, but that digs into your future savings. The countries that did right was Hong Kong and a few other countries, Japan, where they said, we will provide, the state will step in and provide those who need the help with the transfers and so on, or support systems. It's like when you have an earthquake, you don't tell people, hey, go dig into your retirement savings to, to get out of the broken home, right? You provide resources. So I think it was wrong to go and dig into the retirement savings. The government the state should have stepped in and provided the needs of people who needed it during the pandemic. And now we're in this hole where so many people have taken so much out that now we don't have enough. This is the problem. So we need to rebuild it. So what happens when you are 55 and you find out you only have this amount, 200,000, which is not enough for you to sustain yourself? Unfortunately, there's 3 solutions. 1, work longer. Don't retire early, which happens again in America. People just work longer till 68, 72. They just work longer.
Wow.
They did that during the global financial crisis. Many retirees who were planning to retire at 65 went on and worked to 72 because they went into a hole. The GFC wiped out a lot of their investments. The second is you spend less. What to do? You just have to spend less or consume less, right? And the third would be, what else is there? Let's think. I had one more solution, but it slips my mind. It'll come back.
Well, let's talk about working longer or extending the work life.
Yeah.
And that's been one of the proposed solutions. Is that viable? Is that desirable? How do we think that through? Many people, as we start to live longer, life expectancy grows. You're still a productive member of society at 55. And if many Malaysians cannot afford to retire at 55 with the amount of retirement savings they have, is extending the work life something that should be institutionalized, should be made?
Okay, so I think you answered your own question. So
Did I?
People are living longer, right? People are healthier. And basically, when that's the case, and if you are able to work, you should work longer. Whether it should be institutionalized, I think it should be given as an option. Don't force anyone to work longer than they need to, but there should be guidelines. That means if you have an EPF saving system, you need to calibrate the age at which you can withdraw, not too early, right? You have to calibrate in that way. You can choose to retire early if you want, but you can't touch the savings until you reach a certain age. So hopefully it'll be a nudge or an incentive for people to work longer. So, you have to calibrate it, because you cannot say, I want to retire at the age of 54 or 55, and then when you reach 60, you say, sorry, I've run out of money, what can you do to help me, right? You need to calibrate. So that's why you need a benevolent government or an EPF benevolent who cares for the people's welfare to calibrate and find out what's the optimal structure that keeps everyone happy, keeps the country solvent, and makes it happen.
Do you think
I just remember the third reason, the third thing. So I told about working longer, spend less, or save more. you also can start saving more. That means, that's another way of saying you spend less.
Okay.
So, and through the saving more, what happens is you say, again, create incentives. So you're putting aside 12%. Let's say you're putting aside 12%. So again, I'll say, if you put 15%, the government or somebody will match maybe twice that additional 3%. Something like that. Be creative.
Yeah.
Right?
That could be a good catch-up mechanism.
Correct. Exactly.
For particularly older retirement savers. Right?
Exactly. Exactly. So,
Joe, when we think about how this takes, does this all of this the framework and allowing people to withdraw early, allowing people to withdraw a lump sum and then work their retirement saving income out over their life cycle or their lifetime, does it take into account financial literacy and behavioral economics?
Okay, very good question. First, let me address this fact about people taking money out, lump sum. You know, I mentioned about benevolent government. Sometimes we don't know what's good for us.
Yeah.
We need somebody to guide us.
Okay.
So if you have experts who know how to think for you, sorry to put it that way, but who know what's best for you. I'm not saying it's a dictatorial system, but they know that if you take a lump sum, and this is true in many countries, empirical evidence shows, when you take a lump sum, you have this illusion of money thing, money illusion. You think I have so much money and you start spending and then you realize you run out of it very quickly. It's a very common phenomenon. It also happens in lotteries. When someone wins the lottery, have you heard about how people go bankrupt after winning a multi-million-dollar lottery? Yes. It happens in UK, happens in America. It's just this money illusion thing, plus all the relatives who come and say they
everyone's got their hand out.
And their hand out, right? It happens also in retirement. When you get a lump sum, suddenly all your relatives out of the woodwork appear. So I think in some cases we need to guide when you're going to retire, how much you can pull out, and you know, all that stuff. So I'm against also this lump sum concept because we may not know what to do with it. That ties into your financial literacy question. You know, I don't know, there are certain professions when you're under their treatment, they'll talk to you about stocks while you're under anesthesia, right? Everyone thinks they know how to invest in stocks. It's, you know what I mean, right? I'm not trying to diss any profession, but you know what I mean. And I'm just shocked. I went through the top universities. I've got rocket science degrees, and I'm afraid to make some investment decisions. I'm very careful, calibrated, risk averse, but yet these people who have been trained in other fields think they know about stocks. So there's always this overconfidence problem that we have. That said, financial literacy is not something that's easy. It's not a panacea. You can say financial literacy, let's train them, but it's very difficult. It takes a lot of training and understanding. We need good financial advisors to be able to help people navigate through this program. Financial advisors who don't act like brokers. I mean, they're not looking at the commissions. They're independent, they're looking out for the client's good. They're called fiduciaries. There are laws that say fiduciaries who don't act in the interest of the client can actually go to jail. Right? They are called fiduciary responsible advisors. So my view is we need to create a cadre of very good, well-intentioned financial advisors, regulated by the Securities Commission and all that stuff, so they do and act in the best interest of the client. Then the literacy programs has to be a lot less sophisticated. Simple messaging. Don't design it for the highly educated. Design it for the average, lower group people, and you'll get some really compelling messages. If you, again, in Singapore, I spent 12 years in Singapore, and I was advisor to their CPF. I still am. What happens is we learned that putting cartoons and little local village scenes with all the different communities talking to each other about their savings, their life, helps them understand it better than putting all these sophisticated mathematics and arrows and systems diagrams and so on. They don't get it. But when you show cartoons, anime, you show this little simple illustrations, the ordinary people understand it. That's the way you communicate. That's financial literacy. And then leave the investments part to the experts. Well-intentioned, well-trained advisors. That's what I would say. We need to create that. We have too many agents. The agency model here is a bit, it's not just Malaysia, it's many countries
I'm
in
sure
Asia.
that
have
thrive
this
on
form.
commission and all.
Yeah.
Joe, we've come to the end of the show, but thank you so much for shedding some of your insights into how we can maybe mitigate the impact of an impending retirement crisis. Thank you for your time.
You're welcome.
That's all we have for you on this episode of Consider This. I'm Melisa Idris signing off for the evening. Thanks so much for watching. Good night.